Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The U.S. stock market is at new highs, but international flows, they're all over the place. There's been huge inflows into India and Japan, which has reinvigorated overseas investing. But China flows are flat to down as that market hits multi-year lows. Here to make sense of it all is Dave Mann. He's the global head of products and capital markets at Franklin Templeton, and Mike Akins is from ETF Action. Gentlemen, thanks for joining us. Dave, you oversee Franklin's ETF business, including the India, Japan, China ETFs. Talk to us about India and Japan. Why are these both so hot right now?
Yeah, sure. Thanks, Bob. No, I think one of the nice things about the ETF vehicle is you can get target exposure to lots of different things, and specifically what we've seen over the last year is investors looking to ETFs to get single country exposure. One of the hottest countries was India. Our fund FLIN brought in about 600 million over the last year. Part of the growth story, GDP has been strong. A lot of the middle class starting to invest more has been one of the emerging market standouts thus far. So India's been a great story. Japan is always almost like its own region, if you will. So we've seen lots of inflows into FLJP. That's our Franklin Japan ETF. But just more broadly, lots of investors looking to get exposure to those single countries.
Yeah, and I see some names we know very well here in the United States in the India ETF, Infosys and Tata, of course, have been around a long time. India, though, has emerged as the obvious global manufacturing competitor to China. But wouldn't you say, Dave, it's a long way off from really competing against China? I guess that's the sort of concern that I have here about just let's throw all our money into India as an anti-China play.
Totally, yeah. This is definitely the call it the early innings, but just in terms of without getting too far into politics, the mix of call it the democracy, although a messy one, is getting a lot of people to pay attention to India as a long-term emerging market play.
Yeah. Mike, your thoughts here on what's going on with India and particularly and Japan as well. I see in Japan, I see a lot of these names in Dave's ETF that we all know: Toyota, Sony, Mitsubishi, Hitachi. These are names we all know very, very well. What are your thoughts on the inflows here that we're seeing?
Yeah, I think the biggest takeaway is just with the ETF vehicle, it's a great way to get targeted exposure to these countries. I mean, there's over 153 ETFs that track single countries. $100 billion in those markets, and it's very fast-moving money. It's a lot like the sector ETFs. It's a great way to have a macro play. If you look at India, I think there's definitely a story to be had with regard to a new manufacturing hub versus China, but also just the GDP growth story in total. I do think investors should be wary of valuations in that area. If you just look at the India ETFs, they're trading right now anywhere from 22 to 23 times next year's earnings. That's extremely elevated to the most foreign ETFs and very elevated to itself. 10-year average being closer to 18, whereas China is just the opposite, right? It's got a 10-year average PE of 11. Currently, most China ETFs are trading below 8. So there's a story there to be had with respect to the growth, but the market has reacted, and all those inflows have driven up those valuations. So it's something to keep an eye on. But I think it's definitely a macro play. Anytime you see that money flowing in and out of these ETFs, it's a great way to get sentiment about those countries. Japan obviously has got a very stated pro-growth mindset right now after years of stagnation or deflation, and that also has driven a lot of information. One thing I would point out with all of these ETFs, there's two ways to play it in the country ETFs. There's usually a currency where you have exposure to that risk of the FX of that country, and there's the currency hedged. And you're just using the Franklin ETFs, FLJP, as well as the Franklin Japan hedged ETF. I believe the hedged ETF more than almost doubled the return of the non-hedged. So big difference in returns, and you got to understand that currency exposure as it comes to the two different types of strategies.
That's a very important distinction, and I'm glad that you made that. What's amazing to me is just that Japan is a story at all. I was hired. This is my 34th year at CNBC, believe it or not, and I was hired in 1990. That was the peak for, I think Mitsubishi owned 30 Rock at the time. They owned Pebble Beach. And literally it's been stagnating for 30 years. And I'm pleased to see finally something is happening and investors are taking notice and the people managing the country are taking some more pro-growth policies. But darn, it's taken a long time, you know? So I think it's as big a story as the India story was last year on top of that.
Absolutely. I think Japan is an interesting story, just in terms of how much exposure they have across globally, similar to the U.S., but their valuations are so much more depressed, you know, trading at 14 times next 12-month earnings. There's definitely a story to be had for Japan. I'm a little more weary on India, not because I don't think it's a great growth story, but it's got some of the complications that China has. You know, if you look at China and the growth of GDP of China over the last 20 years is, you know, 10x, 13x, but the stock market is flat to down. I think you have to understand those different variables at play. The stock market is not the economy. So Japan, to me, seems a little bit more, well, conservative play, if you will, when it comes to the unknowns.
Yeah. So at the same time, Dave, China inflows have been flat to down. Some are seeing outflows. And you look at Hong Kong, you look at the Hang Seng, you look at the mainland China indexes, they've hit multi-year lows. But the Shanghai and Shenzhen indexes have gone nowhere for 17 years. They're literally at the same price they were in 2007. I mean, think about that, how much China has changed in those 17 years, but the two major mainland indexes haven't changed. So your China ETFs, I looked at, it's got all the usual names. You've got Tencent and Alibaba in it and Baidu, as well as the big the big China banks. So suss this out for us. Why are investors fleeing China right now?
Yeah, I mean, the geopolitical factor with China is certainly on everyone's mind. Lots of different ways to play the China market. Over the last, I call it 5 to 10 years, we've seen Hong Kong and China probably moving a little bit more in sync, especially with China's China's impact on the Hong Kong market. And yeah, as we've discussed earlier, China was down last year. It is down again this year. Investors are probably looking a lot of the political side and also some of the multiples that we discussed earlier here, and thinking, is this the time to dip my toes back into to the Chinese markets, especially for the single country ETF users who are, rotating in and out of these different countries and trying to find what macro view and what signal to do to come back in.
So, Mike, I'm going to ask the broad question about whether China is investable or not. So there's 3 different ways this has played out in the last decade. You've been part of this as well, and so have you, Dave. But 7, 8, 9, 10 years ago, we were all debating about what's the right place for the global portfolio. And basically, everyone was coming down on the side of market capitalization. So if mainland China was, pick a number, 7% of the global market capitalization, you owned a fund that had 7% of mainland China and whatever more added for Hong Kong. There was, on top of that, there was also the value guys, which you referenced there. So China, there were value guys. If China's trading typically at 12 times forward earnings, if it's at 11 and below, I'm a buyer, and I don't care about everything else. But what there wasn't around, that there is now about, is the people who are arguing that the political risk associated with China is much higher than anybody anticipated, and that a lot of investors thought with Xi Jinping, the leader of China, 10 years ago, they were going to get Deng Xiaoping. And Deng Xiaoping was the leader in the 70s, as you know, and brought back capitalism to a certain extent in China with government control. And instead of Xi Jinping as Deng Xiaoping, what we've got is Xi Jinping as Mao Zedong, meaning kill the capitalists. And I think people weren't prepared for that and we're surprised. And so there's a whole nother group now that says the political risk is too high, China's uninvestable. This is a little bit long-winded, Mike, but I'm wondering if you give me your thoughts on this.
Yeah, I mean, I think you laid it out really well there. I think it's kind of the old, cliche, fool me once, shame on you, fool me twice, shame on me. And I think if you look at it from that perspective, you've got this situation where China's economy expanded, the stock market went nowhere. It's been very volatile. There's been periods where it's gone way up, but also come way down. And a big part of that is it's not because the stock market hasn't grown. It has. There's been huge issuance. China is one of the largest IPO markets over the past decade across the world. They've had large secondary offerings. So the capitalization of the market continues to grow, but the returns are nowhere to be found. And that's a good way to put it, is a large part of that is the anti-capitalist stance that China has taken. They're almost taking the investor money and deploying it, back across the country. So, one of the trends we're seeing from that, one of the largest inflows into emerging markets broadly over the last year has been to emerging markets ex-China products.
Yeah.
So now
exactly.
Now you've got a whole new issue that you have to think about when going to that market. Is it investable from a standpoint of total return, or is it, really a growth story in economy alone and not in the actual return of the stock market?
Right. Well, there you go, Dave. I mean, Mike just said it there. What's happening is ex-China indexes are coming out now. That is to me, that's a clear indication that nobody's going to do this unless they think somebody's going to buy it. Obviously, you're in this business too. So there seems to be some kind of market out there for people who think the political risk is too high at this point. Is Templeton going to do this in the future, or do you have any plans?
Yeah, it's from a product pipeline. That's something we're definitely looking at. It's almost the next iteration of giving that target exposure. Is if folks want emerging markets but they don't want China, then EMX China is potentially very attractive and something that we're looking at.
Yeah. Dave, how about some other emerging markets that did very well last year? For example, Mexico did very well last year. Brazil.
Mexico, Brazil was a good one. Yeah, absolutely. South Korea had a strong year, although off to a slow start this year. But it just goes back to the broader, the broader point of these single country ETFs, where you can, have a view and rotate as information changes.
Yeah. I want to move on. Dave, you also run the Franklin Bitcoin ETF. I couldn't do a show without mentioning Bitcoin, folks. You know that. The symbol, those of you who want to know, is EZBC. Franklin was one of 10, actually, it was 10 companies that floated a spot Bitcoin ETF. 9 of them were new. Grayscale was already existing. Tell us a little bit how that's tracking Bitcoin. And we can chat for a moment on the other side.
Yeah, I mean, Bob, to your credit, to ask about international ETFs when Bitcoin is truly, sucked the oxygen out of the room, it was nice to start that way. Yeah, I mean, the last 2 to 3 months, in terms of all the issuers building out the plumbing and the infrastructure to make sure that these spot Bitcoin ETFs did what they were supposed to do. And here we are, and so we're only maybe a week or two into their performance live in the market. But the $1 million question was, investors who like ETFs expect the ETF to track its underlying asset, and in this case, the funds own Bitcoins, and the performance of the funds has been tracking the price of Bitcoin. Across the 10. They're going to have different benchmarks, so maybe the performance will be a little different between the two, but generally, they're all doing exactly what they were supposed to do in terms of tracking spot Bitcoin.
And Mike, one thing people were wondering about, Bitcoin trades 24/7, but the ETFs don't. That doesn't seem to have been a major problem. I'm wondering if you think so. And it looks like the 9 that are new got about $4 billion in inflows. That seems respectable to me. It's hard because I don't have any benchmarks to compare, but that seems fairly respectable number here. Any thoughts on that?
Yeah, I mean, a couple thoughts. One, on the structure side of things, there's no question that the ETF is a superior structure for somebody who wants to buy and hold. Bitcoin as an investment, just like GLD is a superior structure to hold gold versus putting it in your safe at home if it's a investment vehicle. If you're holding it as a speculative investment to gain access to the asset class. So that the ETF is doing it. You got a bunch of smart people in a room creating an arbitrage. It's going to work. We could create an ETF of almost anything. I sure hope we don't, but you could. As far as the flows into the product, I think it's very respectable. The one question I have is, what's more, where's there more demand? Is there more demand to get into these new ETFs? Or is there more demand to get out of GBTC, which is the elephant in the room, right? It's been locked up Bitcoin for a very, very long time at depressed values at a discount. And now it's finally trading at par with the spot price of Bitcoin. And so far you've had 4 billion come into the new 9 ETFs, but you've had almost 2 billion come out of GBTC. So net, it's more money coming into Bitcoin right now. But how does that play out over the long term? I don't know, but it's something to keep an eye on.
But Dave or Mike, it's true. There's 2 billion came out, but it was a $26 billion fund at Grayscale, and they're charging 1.5%. Mike, Dave, you're charging 0.19. Is that right? Right now, 0.19%.
19 bips, wave
to zero.
That's
a big difference. 1.5% versus 0.19% is a big difference, and yet, to me. Mike, it's remarkable how sticky this money is. You'd think that's not 9 basis points or 3 basis points. That's a lot, and yet, they seem to be relying on the idea that the money's going to be fairly sticky. And so far, I think they're right.
There's going to be multiple types of money. Right now, GBTC is a liquidity machine, right? So if you are a big institution looking for exposure to Bitcoin, for now, you have the same story that SPY's had for years, right? SPY tracking the S&P 500 versus the cheaper Vanguard or iShares version. Liquidity matters when you're trading at scale and trading in speed.
The question is, though, the difference is that's 6 basis points when you're talking about SPY and the S&P 500. This is like 120 basis points. This
absolutely
is huge. More than 120 basis points.
And I think that's the question: is how much of the money in GBTC is early money that the tax hit in a taxable account, where the tax hit would be a serious hindrance, versus how much of it is, I know a lot of folks that own GBTC in their qualified accounts, right? Yeah. They're all going to trade out of it. Why would they possibly pay that 1.5% when they can pay 20 basis points to Franklin or one of the other issuers? That's just a no-brainer. I don't think anybody has a clue what that makeup of that $26 billion is. And we're all going to find out, I think, over the next 6 months to a year.
Yeah. So where does Bitcoin and the ETFs go from here? We had SIBO on last week. They were all excited about options potentially coming up. They have the application at the SEC. Hasn't been approved, but you guess where this is going to go. So I'm curious to see anybody who's going to work their Bitcoin ETFs into target retirement and asset allocation funds. Mike, you brought this up when I asked you about where it's going. Is that ever going to happen?
I think it will happen. It'll be a differentiator for a lot of folks to say that we offer that. My personal views aside, it's definitely an easy vehicle to do it in. Model portfolios is the future. Firms such as, there's a lot of big issuers out there that have very large models, so they can feed these accounts. Small allocation goes a long ways in terms of asset growth. I do think you'll see it. Whether that's good thing, well, that remains to be seen. But I do definitely think that the model game, a lot of model providers, whether it's the issuers or strategists, will start adding, and they'll use it as a differentiator to the competition, and we'll see how it plays out.
Dave, I want to meet the people who first go ahead and do that and put it in their model portfolios. Gary Gensler of the SEC made it very clear that there are suitability issues here that are very real. And reg best interests. So would you not agree that's a little bit of a barrier to have this Bitcoin ETF suddenly appear in model portfolios?
Well, that's the, we're all watching these flows, week in, and a lot of the conversations with either asset allocators, models, a lot of the platforms is a lot more, hey, let's wait and see. Let's see how these things are doing. Your question earlier on tracking, we're getting a lot of those types of questions as well. And so there's a lot of research going on to say, hey, what if we added 1%, 2%, or 3% Bitcoin ETF exposure to some asset allocation model? How does that impact the volatility, the Sharpe ratio? Those are, all that math is going on right now, and the early feedback is I think there could be a place for adding this ETF into an investor's portfolio.
Okay, well, there you go. You heard two different kind of opinions there. I think it's going to be a while, folks, before that happens, but we'll see. What an interesting conversation. Two very smart people, as always, here on ETF Edge. That does it for this week's ETF Edge. By the way, my thanks to David Mike. We've asked Mike to stick around and give us his thoughts on broad ETF trends for 2024. That's coming up on our ETF Edge podcast. And remember, you can see all of our shows. They're on the website, all of them, etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.